To illustrate just how difficult 2011 was for the London insurance market, for the 300-plus-year-old Lloyd's market, it was the largest catastrophe claims year on record. However, capitalization among the London market participants overall actually remained strong, and most moved into 2012 with capital to deploy. More on that later. Market reaction to 2011 pretty much ran steady, as Director of Analytics Catherine Thomas said, but she notes that on a company-by-company basis, results ran the gamut.
The impact on individual companies varied considerably, and some did suffer, losing up to 50% of their 2010 year-end shareholders' funds. In the aftermath of 2011, there has been increased focus on the application of event limits for pro-rata business. We've also seen insurers increasingly question the adequacy of pricing in non-peak territories, particularly once diversification benefits are excluded. And then the Thai floods particularly also highlighted challenges involved in ensuring non-modelled perils, particularly in territories where data quality is poor.
Will this market response have a positive effect?
Earnings in the London market should rebound this year, particularly assuming a return to normal catastrophe experience. We've had material price increases being achieved for loss-affected business, particularly in the Asia-Pacific region, and loss experience in the first quarter of the year has been relatively benign. But having said that, for most non-catastrophe classes, market conditions remain competitive and rate increases are modest. That's really because in spite of the 2011 loss experience, industry capacity has not contracted substantially. At the same time, we're seeing quite stagnant growth in developed economies, which has been curbing demand. And then the other factor that's coming into play is that reserve redundancies, which have made a material contribution to the results of listed London market insurers and the overall Lloyd's market in recent years, are expected to reduce this year.
As for the deployment of capital, well, that remains to be seen.
That's certainly something we're monitoring quite closely. At the moment, you have low share price to book valuations and the absence of a strong market-wide upturn in rates. And there is a possibility that may encourage insurers to return rather than to deploy their capital. But given the turbulent global economic environment, there are concerns regarding the ability to recapitalise after a major event. And I think that's really going to weigh on any decision to embark on a material share buyback programme, particularly ahead of the US hurricane season.